Welcome, everyone, to this Sunday, May 19th edition of the EB Weekly Market Recap. I'm Tom Bowley, Chief Market Strategist with EarningsBeats.com, and I'll be your host for the next 30 minutes or so as we work through the action from last week. I'll give you my take on everything that occurred and try to get ready for the week ahead. I'm going to go ahead and start off this morning with a chart of the Dow Jones. Kind of summarizes really what we were looking at throughout the week. As I zero in on this chart over here, you can see I just jotted down a few executive bullet points of things that occurred during the week, things I think were pretty good takeaways. First of all, record highs everywhere. I know April was a really rough month for many. But we have come roaring back. We bounced off of 20-week EMAs in most cases, and that's a major support level when you're in a secular bull market advance, and they have proven once again to be excellent support levels. But we are now bouncing record highs, like I said, just about everywhere across most of our major indices. We had the CPI declining last week. We had both the PPI and the CPI reports out. Of course, I focus a lot more on the CPI report, and on Wednesday morning, we had the latest. We got the April CPI and the April core CPI coming in a little bit better than expected. And as a result, we saw the CPI annual rate dropping. Interest rates dropping, of course, with that lower inflation rate. I think there's a lot of bond folks out there, bond traders that wanted in. Believing that the worst is behind us on inflation. And as a result, with all the buying, we saw the 10-year treasury yield declining. Volatility tumbling last week. This is really, really key because if you've studied history, you know what a low volatility index means. It means bullish price action. Until we break out of this pattern of remaining under 20 on the VIX, the stock market is likely to continue going higher. So really important to note that volatility. I'll be pulling up some additional charts throughout the show. Retail sales flat. Again, when you're looking at the economy and you're worried, okay, well, we don't want to be overheating because that would just put more inflationary pressures out there. That's not the case. We saw retail sales flat. So I think that kind of went right along with the story of lower inflation expectations ahead. Growth back in favor. Talked about this really going into May. A lot of folks saying go away in May. One of my counterpoints is that growth from May to August, that is the best time of the year to be in growth stocks relative to value. Probably not a whole lot of folks realize it because they don't talk about it in mainstream media, but growth loves May through August, and we've seen the return to growth stocks here over the past couple of weeks. Finally, short squeeze mania. I don't know how many of you follow short squeezes, but we have a chart list that's dedicated just to stocks that are heavily shorted for weeks, maybe last couple of weeks, but basically for weeks like we had last week and maybe the week before. That's why we keep the chart list. Many, many months will go by sometimes without any action in that chart list, but when it goes, it screams. There was one stock on it, FFIE. It was trading probably a little bit over a week ago at 5 cents, 0.05. It almost hit $4. Think about that for a minute. That's almost 80 times what you would have paid for it a week and a half ago. 80 times. You put $1,000 into it, it's 80 grand. Put $100 into it, it's still 8 grand. I mean, that's the type of moves that you can have. What I describe it as is a market inefficiency. And as short-term traders, we like to try to take advantage of short-term market inefficiencies. Short squeezes are one of them. I'm going to talk about that. I'm not going to talk about that anymore during this show, but I am going to dedicate some time just to that during the Fab 5, which is another video that I put out on the weekend. That'll be coming out later today. So make sure you check out the Fab 5 video. I'll talk about the short squeeze in much more detail. Anyhow, let's move on and talk about the record highs everywhere, first of all. So here's the Dow Jones. You can see coming across Everything looks fine. But if you go back to 2020, 2021, during the uptrend, this is a weekly chart, by the way. If you look up here, weekly chart, check out what happens when we go down and we test 20-week moving averages. This entire run in 2020 and 2021 on the Dow Jones lived primarily above its 20-week moving average. We had 1 week right here in October of 2020 where we dropped below the 20-week, came right back up above it. We came right down to test it. We narrowly avoided testing it early in 2021. But you can see, any chart that's trending higher, look at it on a weekly chart, and you'll see many, many successful tests at the rising 20-week EMA. I use it. I talk about it. When we were having all the struggles back in April, one of the things I said was watch the 20-week moving average. What did we do? We went right to it, tested it, and right back up to all-time highs. Now, this is the Dow Jones, which closed on Friday at 40,003, by the way. First time in history closing above 40,000. That's a big psychological level. Didn't exactly clear it by a lot. Maybe we pull back from here, and have a little bit of some profit taking. But that, make no mistake about it, that was a very, very bullish breakout on Friday. S&P 500, actually the S&P and the NASDAQ broke out a little bit earlier in the week. But you can see the first close above 5,300 was last week. And I believe that was on Wednesday when we closed at 5308, or I don't remember exactly where it was. But we came back down a little bit later in the week, but still a very, very solid week and a breakout. Now, some of you astute technicians may say, but Tom, what about the negative divergence? Lower PPO, higher price. That is a textbook definition of a negative divergence. Here's the problem. We don't know how far this is going to go up. We don't know if this is just going to die out, start heading back down, or if it just continues to move up, in which case we're already starting to see the PPO turn up. And if we break back out again on the PPO, the negative divergence will be eliminated. So that's the thing that a lot of folks, I think, get wrong about divergences, is they'll look and the first sign they see of a negative divergence, they're like, oh, there it is. That's a top. I think you got to be a little careful and not be premature with that call, because like I said, if we continue moving up, we've had negative divergences in the past. But if price action keeps moving up and that PPO moves back to a new high, the negative divergence goes away. The NDX, NASDAQ 100, also breaking to a new record high. The NASDAQ composite also breaking out to a new all-time high. How about the S&P mid-cap index? Well, right up near an all-time high. How about the small cap IWM? Lagging, getting close to a 2024 high. Still got a little bit of ways to go to get up to that 2021 high, which was a little bit above that 230 level. So IWM, small cap, still underperforming by a bit. No doubt that the large caps, year to date, we've seen large caps now leading again, market to the upside. And I'm not sure exactly when that changes, but I do believe you're going to see a lot of catch up later this year in the small caps. Let's get through that 210, 211 area first on the IWM, and then we'll see where we go from there. Moving on to the sectors. So those were the major indices that I like to follow. And by the way, I didn't pull up the transports. Transports, very weak again, not really participating. If you want to look at some things that are negative, that certainly would be one of those. All right, sectors, technology breaking out to a new high. How about communication services threatening the high that we had back in 2021? That was in the neighborhood of about 83, 84. We closed last week at 82.61. We got up to about 84 beginning of April. So we know where the resistance level is. It's right where we are right now in the XLC. A breakout there would be very bullish. Let's see. Oh, and this is a good example of where you can get a negative divergence. Look at this breakout. See how we broke out and started setting highs back in November of last year? Higher highs. Let me zero in, make sure you can see this pretty well. Went to new highs. Look at the PPO. When we first made that breakout right there, the PPO is still down here. Negative divergence. We should be selling, right? Well, that wouldn't have worked out very well. And eventually we went right back up and set a new PPO high. So no negative divergence. Now on the last one, we have a negative divergence here, slight one, very slight lower PPO reading with higher price action, went down to the 20-day, starting to roll back, 20-week, starting to roll back up again. PPO not exactly turning back up just yet. So communication services has been strong in 2024. It's been our best sector, but it is starting to show some signs of maybe a little bit of weakness or maybe just needing some consolidation for a period of time. But if you see another reversing type candle, a false breakout past that 84 level and come back down, maybe close on the low of the week with this kind of a PPO, I would think that the odds would be greater that communication services is more likely to take a rest than not. So something just to watch in the week, maybe the next week or two, as we follow the market action to see if we get confirmation and further breakouts across these indices and sectors that I'm showing you. All right, next up, we got discretionary. Discretionary hasn't been as strong. It's not a bad chart. I mean, we haven't gone back through the 2021 high, but since the cyclical bear market ended back in 2022, we have seen a steady move to the upside. It's just been slower, much more methodical, and as a result, we've seen relative underperformance. But overall, we're still trending higher, and I don't see anything technically that suggests that discretionary is going to break this uptrend and go lower. It's just not one of the leaders out there at this time, and that's okay. You can't be, all the aggressive groups don't all lead at the same time. Next up, XLF financials breaking out again to a new high. Once again, negative divergence, but how high is this going to go? Be careful calling that too early. Trying to look, I mean, kind of what we saw here back in early 2021. See, we got weakness almost to the 20-week, came back up, set new highs. We had a temporary negative divergence and prices kept going up, and the negative divergence, a slight one, went away. That's what you have to be careful about. XLI, industrials, testing the high that was set back at the beginning of April, not quite through it, but still overall nice uptrend. And all these charts I'm showing you, by the way, we've been seeing for the most part rising 20-week EMAs holding as support. Healthcare, beautiful breakout, came down just below the 20, turning back up again. Looks to me like it's ready to make the break. Sometimes, here it was a break below that 20-week moving average, just barely, but we never lost price support. That's the other thing. When I get a breakout, I'm always looking for that 20-period EMA to act as support, but we also want to look at price support because there's nothing more important. Moving average support is not as important as price support. So when you've got sideways consolidation and you finally make a break, notice we never went back and closed below that prior high. So I think support held, we're turning right back up again. So again, that was healthcare. We look at Staples. Staples breaking out. You might say, well, that's bad. Staples are breaking out and discretionary is not. Well, everything's relative. If you go back and you look at 2020 and 2021, discretionary went up, I think, from like 80 to 210. And during the same period, it might have been from the lows that I calculated that 80 to 210. But here from the low, 44 through early 2022. Well, actually, I think it was 2021. But regardless, 65 or 70 from 44. So it wasn't even a double. If we take a look at that XLY from the low 80 to the high 210 at the end of 2021, do you see how much crazy outperformance we had on discretionary for that period of time? So since then, I think it's just been this sideways consolidation for the XLY. And because Staples finally was able to make a breakout, it's looking like Staples are really leading. Staples are not leading discretionary. Staples are leading discretionary in the short term. That long-term chart remains, in my opinion, intact and still moving higher. XLRE, how about real estate? Real estate getting healthier. Took a while, but we were downtrending. We finally broke that downtrend at the beginning of November when we had that big run at the end of 2023. Made that breakout, and since then we've had one scary candle here, I would say. Otherwise, we've been doing well, and what we're looking for now in the XLRE is a weekly breakout above 40 bucks. XLU, utilities, very, very strong, but this is a group that has been underperforming the S&P 500 for years. Finally showing some relative strength, which is good, but don't misconstrue this. You know, every once in a while we'll get a good period in utilities and they'll outperform for a bit. Doesn't last. Not during a secular bull market. I believe we're in a secular bull market, and while utilities may go higher, I do not expect them to be leaders. XLE, energy, mostly sideways. We did get the breakout. We are in an uptrend, but we've certainly gone sideways more over the course of the last year and a half or so. So it's been an okay group, but it's been a lagging group. Materials, same thing. Look at this for a couple of years. When inflation was really starting to rear its head, I had a lot of folks jumping into material stocks. Since then, it went sideways. It did finally make a breakout. And it's fine. We want wide participation. We want all groups moving up. I would say every one of these charts looks good to me. Real estate was a little so-so, and I guess you could say, you know, while it's consolidating, the XLY lagging for sure in 2024. But for the most part, all of these groups are participating. This is what you want to see, and it's a hallmark of a secular bull market advance. So stick with the bull side. Let's move on to the interest rates. So interest rates came back down. You can see over the last few weeks, they've been moving back down. What I also find interesting is that since the end of 2022 or in the fourth quarter of 2022, we're basically where we were then. So we're flat, maybe up just slightly. And during this period, the inflation rate has been going straight down. I'm going to show you that chart in just a minute. But from the end of 2022 till now, yields have been sideways to just slightly above. And now take a look at the inflation. Here's inflation since 2022 going straight down. So I think what the interpretation that I'm getting from the bond market is that maybe for a while there was some concern about inflation, but I think the fact, and I talked about this probably over the last 6 months or so, I think we're starting to move back into a more normalized interest rate environment. You know, we had with the pandemic, we saw rates drop all the way down to, you know, zero, almost 0.4, whatever it was on the 10-year treasury yield. And then, of course, we had all the inflationary residue after that. And as a result, we had the rates, you know, soaring back up. But it seems like over probably the last year to year and a half, things have begun to normalize with the 10-year treasury yield. Because normally what I would have expected if we were just going to, you know, just follow this crazy up and down in inflation is that when the yield went up 2021 through the end of 2022, and we can take a look at that. So here's 2021 all the way through the end of 2022. You can see that yield was rising considerably. And the reason, quite honestly, is because inflation was moving up. It wasn't so much that rates were going up because of the economy, or if they were a little bit because of the economy, it was masked by the fact that we had all this inflation, the inflation worries. And that's what the Fed was talking about when raising rates. They wanted to get inflation in check. That was their biggest priority. But look at what has happened in the last year and a half. This the annual core rate of inflation at the consumer level has dropped from 6.7% down to 3.62. And the Fed keeps talking about inflation. The market's moving on. I can tell you right now, the market is moving on. With rates dropping, I think now the fact that the 10-year treasury yield is still staying up a little bit, to me, it tells me that the bond market still believes the economy is going to be fine coming out of this. And in fact, when rates start dropping on the short-term rates start dropping, Fed funds rate, I believe this, with the yield staying where it is, it's anticipating a decent economy, maybe a strengthening economy. And as a result, we're going to get that inverted yield curve to flip. And that is going to help out a lot of small banks in this country. Small, mid-sized banks that have been struggling for a long time. They've been struggling more with this inverted yield curve than the large banks have. That's going to hopefully rectify a lot of issues in that small cap and mid cap arena. Anyway, moving back to the inflation, what I did is, and this is really important, you need to zero in on these monthly core CPI readings that I put up here for you. Each month's core CPI has been since the beginning of 2023. So in January 2023, it was 0.43. When we came out with January 2024 at 0.39, we're replacing the earlier January reading with the later January reading, which was 4 basis points lower. And as a result, we saw the CPI, the annual rate drop. February, 0.47 in 2023. February 2024, 0.36. We came down another 11 basis points. 2023, March, 0.32. This was 0.36. That was when we saw that little blip. And as a result, when that came out, that was actually came out in April. And that is one of the reasons why we saw the dip that we saw in the stock market in April. The April reading, which came out in May, just came out, 0.47 was 2023. 0.29 is 2024. We just dropped 18 basis points. And now that core rate of inflation is at 3.62 from where it was before at 3.80. We continue to drop. We took yet another drop to the downside. And that was one of the big reasons why the stock market did what it did last week. It sees this inflation continuing to drop. And as a result, I think they're looking for the lower interest rates to kick in sooner than later. Now, I'm going to point out something that I feel is really interesting. And that is, if you look at the readings from 2023, the 3 lowest readings came in June, July, August. Okay. So they were reported in June, the June would have been reported in July, July in August, and August in September. So when we get our June, July, and August 2024 CPI readings to come out this year, we're going to have tough comparables, is what I'm saying. So does that mean that all of a sudden, maybe July, August, and September, we start hearing more about, oh, wait a minute, inflation's not under control? Because I can tell you that's how mainstream media is going to spin it. And the interesting part about this is July through September is historically the worst time of the year for the stock market. And it's also been the worst time of the year for the stock market in presidential election years, which we have this year. So sometime latter part of July, late part of July through September, I'm already thinking that could be a period that's a rough period for U.S. equities. Just keep that in mind, keep it in the back of your head, because the next reading we have, May, 0.36, chances are we're going to come in better than that, and we're going to lower that annual rate again. And I say that because I believe we're now getting back to normal on inflation. And normal in inflation, when you look back, I mean, you might climb to 0.4 once in a while, but for the most part, these readings come in around 0.1 to about 0.3. And so that average is 0.2. You multiply that times 12, you get 2.4 annual rate of inflation. That's what we normally have. And I believe that's what we're going to. However, we've got some rough comps coming up in the June, July, and August readings, which will be out in July, August, and September. keep that in mind. All right, volatility index, just wanted to mention, I mean, we've seen a huge tumble. Looks pretty similar to what we saw back late October into and throughout November. What happened to the stock market after we saw that? I see straight up. Just did basically the same thing. Closed down at 1199, right down where we were in December. And the VIX went up, but prices kept going up. The VIX, when it's down below 20, has a tremendous track record of leading us to stock market gains. So I absolutely love the fact that we have the VIX back down at 12. And I think that bodes very well for the stock market, at least in the near term. I'm talking about maybe these next couple months. I wouldn't be surprised to see a continuing rally that maybe on the S&P takes us to 5,500. Wouldn't be surprised. But then I think we're going to probably hit some rough waters over the summer for some of the reasons I talked about. XRT, just wanted to pull this up. Retail, I told you retail sales were flat. The April retail sales that came out last week, I think thought it was on Wednesday, but maybe it's Tuesday. Anyhow, we did pull back after an earlier move higher in the initial part of the week. Came back down, finished just a little bit higher for the week, but overall, we did see some selling into the end of the week. We'll see how this group does next week. Sectors. Just wanted to point out technology back in front. I mentioned that there are, definitely some signs out there that large cap growth is returning to favor. If we look at the technology sector and zero in, the groups leading computer hardware and semiconductors. That's important because these two groups tend to do very well during the summer months. First of all, let's take a look at the computer hardware group. Computer hardware, big gap up with Apple's earnings back earlier in May, continuing to move higher just like Apple is, and not too far now from a breakout. So I like what's going on here. That PPO on the daily chart, very, very strong right now. Any kind of a pullback, I think, is a buying opportunity in computer hardware. The others group I wanted to mention was semiconductors, which also had a strong week. They did come down a little bit at the end of the week, but it looks to me like almost, I don't know if you want to call it a cup. Maybe it could be an inverse head and shoulders. Maybe we get a little weakness at the beginning of the week to put in an inverse right shoulder, but I believe this goes higher. I love this PPO coming back up, crossing above the center line and pointing higher. That means that the bullish momentum is accelerating. The short-term moving average is pulling away from the long-term moving average. That is the definition of building momentum, building bullish momentum. So watch for a breakout. That would come at 16.5. We did not get that all-time high last week on semiconductors, but we did see a lot of strength, and we're not far from that breakout. That would be a breakout that I think would really confirm everything else that we have been talking about in terms of this secular bull market advance. Seasonality. Just very quickly, wanted to just show you the seasonality of computer hardware. I'm going to go back 12 years because that's when the secular bull market started. April 2013, that's when the S&P 500 took out the highs from year 2000 and 2007. So once that was confirmation to me that a secular bull market, a new one, was now underway. So going back just through 2013, so we can see how this group has been performing during a secular bull market. You can see right here, the best 4 months, consecutive months of the year for computer hardware: May, June, July, August. If you add these across, that's 4.5, 11.2, 15.4. Computer hardware over the last 12 years has averaged going up 15.4% just from May to August. I wouldn't ignore it. Also, semiconductors. Take a look at the semiconductor group. Loves the month of May. I mean, we've started rolling here. Look at this move in May historically. Look at these averages. 5.8 in May, 3.9 in July. The only other month throughout the year that tops those two is November. So we got 5.8, 3.9, and in between, not great months, but they are positive. So if you, again, May through August, add this across, that's 6.1, that's 10. 10.4% average gain in just 4 months over the summer months in the semiconductor area. So this is a group that we continue to favor. Last thing I want to mention is that we have started our spring special. If you have never been a member or you want to become a member, you can start a trial right now. You'll get your trial period, and then you will get our best deal of the year. So if you click on that, it'll bring you to a page that talks about the services we offer. This spring special, by the way, is valid through June 2nd at midnight. That's Sunday, June 2nd. Got a couple weeks. Great time to kick the tires with a 30-day trial so that you can make a decision by June 2nd on whether you want to extend using our spring special. If you do extend, you don't lose the last couple of weeks of your 30-day trial. The special will be added on to it. So I just want to make sure that even if you make that decision and say, yep, I like the service, you're not going to lose the balance of your trial. You still get that. But if you scroll down, you'll see some of the things that we do for our members. We'll talk about, the various services that we offer, and then the deal. If you sign up for 1 year with us, we give you 2 free bonus months. So you're getting 14 months for the price of 12. You sign up for 2 years, you get 6 free months, 30 months for the price of 24. And if you want to go out 3 years, we'll give you an entire year for free. So you're getting 4 years for the price of 3. Anyhow, it's a great deal. Members can tell you this is the best deal we offer all year long, hands down. You're not going to get a better offer. Also want to mention, if you just want to try us, just start to learn more about us, we have a free newsletter, no credit card required. Name and email address is all that takes. We've had some great articles over the past couple of months. Certainly that would help in your education if you're looking for more education. Hopefully everyone out there is looking for more education, because I wake up every day looking for more education. But if you want to learn more and more about the market and the way we approach the market, you can join tens of thousands of folks that have already joined our EarningsBeats Digest. We'd love to have you. Anyhow, that's basically what I have today. Do like the channel if you like the show today. Subscribe. We'd love to have you as a subscriber on our YouTube channel. We're trying to build that community and make more awareness available for everyone. Stock market is not what you get in mainstream media. You got to be willing to look under the surface for other signals. Follow the charts. The charts don't lie. The charts don't have an agenda. They simply tell you where the money's going. Have a great day, everybody. Happy trading.